Ethan was 29 when he decided to buy his first house. It wasn't because he had run all the numbers or crunched spreadsheets. It was because he felt a quiet pressure creeping in from friends, family, and social media. Everyone around him seemed to be buying property, posting proud selfies in front of their new doors, or bragging about building equity. His parents reminded him that renting was wasted money, and casual conversations with coworkers reinforced the idea that owning a home was the first real sign of adulthood. The messages piled up until Ethan started to feel like he was falling behind. After saving $50,000, he finally felt ready. He stopped questioning and began searching for a home in the suburbs of Atlanta. He found a modest 3-bedroom townhouse priced at $400,000. It wasn't a dream mansion, but it had a small yard and a driveway, milestones he could show off to his parents and friends. He put down $50,000, 10%, and financed the rest with a mortgage at 6.5%. His monthly mortgage payment came to around $2,500. Then came the other expenses Ethan hadn't fully considered. Property taxes added $400 per month. Homeowners insurance cost $170. The HOA fee for the neighborhood was $200. Adding all of this together, Ethan's monthly housing cost climbed to nearly $3,270. For comparison, his previous apartment had been a clean 2-bedroom unit just 10 minutes closer to work, costing $1,900 a month. The rent had included maintenance, a reliable landlord, and no sudden repair bills. The cost was predictable, and the commute was shorter. Ethan justified the difference by telling himself the same story everyone had told him since he was a teenager. Renting was throwing money away, while a mortgage was building wealth. He ignored the fact that he was paying nearly $1,400 more per month than before. It didn't matter that much of that payment wasn't actually adding to his net worth. On paper, he was an adult now, and adults bought homes. 5 years later, Ethan started to feel uneasy. Not because he couldn't afford his monthly payments. He could, but because the math didn't match the story he had been told. Over those 5 years, he had spent over $195,000 on housing-related costs. His townhouse was now worth around $420,000, a modest increase in a market that had cooled after several years of rapid growth. His mortgage balance sat at $320,000, leaving him with roughly $100,000 in equity. At first glance, that sounded impressive, but a closer look told a different story. That equity wasn't liquid cash. He couldn't invest it or spend it without selling the house or borrowing against it. Meanwhile, an alternative path he had never seriously considered revealed a stark contrast. If Ethan had continued renting at $1,900 a month and invested the $1,370 monthly difference into a simple index fund earning an average of 7%, he would have accumulated around $110,000 over the 5 years. Add his $50,000 down payment, which could have grown to about $70,000 if invested instead, and his total liquid net worth would have been approximately $180,000. Instead, his home equity was just $100,000, leaving him nearly $80,000 worse off than if he had rented and invested. Yet, if you asked Ethan, he would still insist that buying was the smarter choice. His belief wasn't grounded in math. It was rooted in a story he had absorbed from every angle of life. A story that buying property equals financial progress, while renting equals wasted money. The truth, as Ethan would eventually learn, was far more complicated. Homeownership comes with hidden costs that aren't immediately obvious. Property taxes, insurance, maintenance, HOA fees, and interest payments all quietly drain wealth while being mislabeled as investments. These costs are scattered and delayed, unlike a simple rent check, making the financial impact feel less painful, but no less real. Ethan's confusion about his finances didn't come from a lack of effort. He was diligent with his payments and had followed every rule he had been told. The problem was that no one had shown him the full picture. While his equity had grown slowly, much of the money he had spent over the years, interest on the mortgage, property taxes, insurance, maintenance, and HOA fees, was gone forever. That money wasn't building wealth. It was disappearing quietly, disguised as the cost of owning a home. This is where the 5% rule becomes powerful. The 5% rule is a simple framework that compares the true annual cost of owning a home to the cost of renting. It captures the unrecoverable costs of homeownership. roughly 1% of the home's value per year for property taxes, 1% for maintenance and repairs, and 3% as the cost of capital, the opportunity cost of tying up your down payment and mortgage in an illiquid asset. Together, these components add up to approximately 5% of a home's value annually. For Ethan, that meant that the $400,000 townhouse he had bought was costing him about $20,000 per year in total, beyond just the monthly mortgage payment. That's almost exactly the same as the break-even point between renting and buying. If he could rent a comparable home for less than $20,000 a year, or about $1,670 a month, renting would be the better financial decision. Any rent above that amount would start to justify buying. Applying this to real-world scenarios is eye-opening. For instance, in cities where home prices have surged far faster than rents, like San Francisco or Los Angeles, the 5% rule often reveals that renting is dramatically cheaper than buying, even if homeowners believe they are building wealth. Ethan's townhouse, in contrast, was in a moderate market, so his numbers weren't extreme, but the lesson remained. The costs of owning a home are rarely obvious. Another hidden factor is opportunity cost. Ethan's $50,000 down payment wasn't just a payment toward the house. It was money removed from other potential investments. If that $50,000 had been invested in a diversified index fund earning 7% annually, it could have grown to nearly $70,000 over 5 years. By contrast, the home's equity grew only modestly, leaving Ethan with far less accessible wealth. The financial trade-off was stark, yet he had never considered it when he signed the papers. Maintenance is another subtle drain. While 1% per year of a home's value is a common estimate for routine upkeep, real-life costs fluctuate dramatically. 1 year might pass with minimal repairs, but the next year could bring a $12,000 HVAC replacement, a $15,000 roof repair, or a $2,500 water heater replacement. These one-off costs are unpredictable and can suddenly make owning a home much more expensive than renting. Renters, by contrast, never face these shocks. They call the landlord and move on. Transaction costs are just as sneaky. Selling a home often requires 5 to 6% in agent commissions, plus closing and transfer fees. On a $400,000 property, that's $20,000 to $25,000 lost in a single transaction, money that evaporates regardless of market appreciation. These costs alone can delay any financial gain for years, especially if a homeowner moves frequently. Despite all of these hidden costs, Ethan and countless others continue to buy homes under the assumption that mortgage payments equals equity equals wealth. It's a deeply ingrained narrative reinforced by family, friends, and media. Yet, the math tells a different story. Ownership is not automatically wealth building. Without understanding the 5% rule and the true costs of homeownership, buyers risk overpaying and underbuilding wealth, all while believing they are making the smart choice. Ethan finally began to see the larger picture. The costs of owning a home were far more than the monthly mortgage payment. The 5% rule helped him realize that owning is essentially paying for housing, just in a less obvious way than rent. But the next question lingered. What about appreciation? Didn't homes usually go up in value? This is where many people get trapped in the myth of guaranteed wealth. Yes, home prices often rise, but the real return, adjusted for inflation, is far smaller than most assume. Nobel laureate economist Robert Shiller studied decades of housing data and found that the average real return on residential real estate is roughly 1% per year over the long term. Compare that to the historical real return of about 7% per year for stocks. Tying large sums of money into a home instead of investing in the market is a trade-off few consider. Let's put this in perspective. Ethan's $400,000 townhouse, appreciating at 1% per year, would be worth around $420,000 in 5 years. Meanwhile, if he had invested the $50,000 down payment plus the difference between his mortgage and previous rent into a stock index fund at 7% annual returns, he could have accumulated closer to $140,000 in liquid, accessible wealth. On paper, the house had $20,000 in appreciation, but his liquid investments could have grown far more, and with immediate access. The difference is striking. Location and market dynamics also matter. In high-cost cities like San Francisco, the 5% rule reveals that renting is dramatically cheaper than buying. For example, A median $1.2 million home carries a 5% annual cost of $60,000 or $5,000 per month, while renting a similar property costs only $3,200 per month. In Austin, Texas, where home prices are lower relative to rent, the gap narrows, but renting still often wins on a pure financial basis. Only in smaller, more stable markets, like Cleveland, Ohio, does buying start to make sense financially because rents are closer to or higher than 5% of the home's value. Ethan also learned about the importance of time horizon. Buying a home only makes sense if you're confident you'll stay in the property long enough, generally 7 to 10 years, to offset transaction costs like agent commissions, closing fees, and taxes. Moving before that period can erase any financial advantage from owning. This explains why many first-time buyers, pressured by social expectations, end up paying more than they realize. By the time Ethan ran the numbers, the choice was clearer. The townhouse offered stability, control, and the emotional satisfaction of ownership, but it was not a superior financial move. If he had rented and invested the difference, he would have been better off, liquid wealth-wise, by tens of thousands of dollars. The lesson was not that buying is wrong. It's that buying without understanding the math often leads to disappointment. Finally, Ethan discovered a process to make decisions with clarity. First, identify a realistic home you would actually buy. Second, calculate 5% of its value and divide by 12 to get the monthly break-even rent. Third, compare this number to what you'd pay to rent a similar property. Fourth, consider whether you can genuinely commit to the property for at least 7 to 10 years. Fifth, if renting, calculate the potential wealth accumulation by investing the difference. The 5% rule doesn't tell you whether to buy or rent. It reveals the truth about the trade-offs. Renting is not throwing money away. It's paying for housing in a transparent, flexible way. Owning a home is not automatically wealth building. It's paying for housing with less visible costs and fewer options for liquidity. By understanding these dynamics, Ethan finally felt empowered to make a choice that aligned with both his lifestyle and his financial goals. Ethan didn't become wealthier the moment he understood the 5% rule, but he became something far more important: aware. Aware that buying a home isn't automatically smart, aware that renting isn't automatically failure, and aware that the real danger isn't the decision itself, but making it without understanding the math behind it. If this story changed the way you think about buying versus renting, then it did its job. Because financial progress isn't about following tradition. It's about asking better questions. If you want more stories that break down money myths with real numbers, real trade-offs, and no hype, subscribe to the channel. And before you go, ask yourself one simple question. Are you making financial decisions because they make sense, or because everyone else told you they should?